Have you ever bought something for your business and thought to yourself, it's fine, I'm just gonna write it off? Maybe it was a dinner with a client, a trip, or a new piece of equipment for the business. And if that sounds familiar, you're not alone. I hear that from business owners every single week, and it does not matter where the business is doing $1 million a year or $10 million a year. At some point, taxes come out, and the phrase come out like it solves everything. Oh, I'm just gonna write it off. Vacation, the dinner, the home office, the car, the phone, all of it written off. But here's what nobody tells you. That phrase can actually become one of the most expensive ways for business owners to think, not because deductions are bad. Deductions are normal and important part of running a business. The problem is that writing something off is not the same as having a strategy. And a lot of business owners have been doing one while believing they're doing the other. Today, I'm going to show you exactly what deduction actually does to your tax bill, where the IRS really draws a line, and what the difference looks like between a simple write-off and a tax strategy. But first, I want to fix the math because once you see this, everything else today is going to make a lot more sense. Here's the most important thing I am going to say today, and I want you to really hear it. A tax deduction is not a dollar for dollar reduction in what you owe. I know that sounds simple, but the way most business owners behave, you would think that spending $1,000 on something deductible means you just got $1,000 for free. And that is not what is happening. And the gap between what people think a write-off does and what it actually does is costing people real money every year. Here is how a deduction actually works. When you spend money on a business, that expense reduces your taxable income, not your tax bill directly. It lowers the amount of income that gets taxed, hence reducing your taxes. So let's look at a simple example. If you're in a 35% combined tax bracket, federal, state, and self-employment taxes, and you spend $1,000 on something you call a business expense, you do not save $1,000. You save $350, which means you are still out $650. A write-off is not free money. It is partial discount on real expense, usually somewhere between 30 and 40 cents on a dollar, depending on your tax bracket. That's it. So when someone says, I write off everything, what they're really saying is this: I'm spending money and getting around a 30-cent discount on it. And I have decided to call that a strategy. A deduction reduces your taxable income, not your tax bill directly. And the actual savings always depend on the tax bracket you're in. I'll link the IRS resource in the description below so you can read it yourself. I'm thinking about a client I worked with not too long ago. He was a contractor doing a few $100,000 a year. Good business, busy schedule. He had been running it for years and felt like he had his taxes pretty well figured out. When he first sat down, he told me something I hear all the time: I write everything off. And in his mind, that meant he had his taxes handled. The truck was a write-off, tools were written off, dinners were write-offs, and part of trips were write-off. And because of that, he believed he was saving huge amounts in taxes every year. And then we actually walked through the numbers together. We looked at what he spent and what his deductions really were. And then we calculated those deductions, how they actually saved him based on his tax brackets. And the moment the math showed up, he was shocked. The tax savings he thought he had were not even close. And they were maybe a third of what he believed. He sat there for a second and said something that stuck with me. So I have basically been spending money thinking the government was paying for it. And when he saw the math clearly, his entire perspective changed. I know, the math misunderstanding is frustrating, but it's not even the biggest risk. The bigger risk is that this mindset leads you to do next. When you believe everything is a write-off, you start making spending decisions based on the tax treatment instead of what the business truly needs. You buy things the business does not actually need because they're deductible. You start blurring the line between personal expenses and business expenses. And instead of asking, does this actually serve my business? You start asking, can I justify this as a deduction? And those are two very different questions. And the IRS knows exactly the difference. So here's something simple I want you to go do this week. Pull up one expense you have been calling a write-off, preferably a recurring one, and ask yourself honestly, would I still pay for this if it were not deductible? If the answer is no, that's your signal. You're not saving money. You are spending it with a justification attached. Now, the math alone should already change how you think about deductions. But this is where things start to get more serious. The real danger is not just misunderstanding the math, it is the audit exposure that builds underneath it. I want to tell you about a business owner we work with with a few years ago. He was doing about $800,000 in revenue. Sharp guy, ran a tight operation. He had been working with another CPA for 3 years. And on paper, deductions looked aggressive. There were meals, travels, a vehicle, a home office, and some marketing expenses that were a little loosely documented. Nothing that looked blatantly fraudulent, just optimistic. When we review his return, a few things stood out. Almost immediately, the vehicle was being used for about 40% for the business, but the deduction on the return showed 90%. Meals were labeled client entertainment, but there were no receipts with the client names listed, no documented business purposes, and the home office calculation had not been updated in years. Even though he had moved in a larger home, none of this looked intentional, and there was no obvious fraud. They were just a write-off everything mindset that applied consistently, years after years. Now, imagine the IRS pulled that return. Those deductions get reviewed. Several of them get disallowed, and back taxes are owed. Interest gets added, and the deductions that felt like savings for 3 years suddenly become liabilities. I see situations like this more often than people realized, and a business owner comes thinking their tax situation is pretty normal, but when we review the tax return for the prior year carefully, we start noticing patterns. Maybe the mileage percentage on the vehicle is far higher than the actual business use. Maybe travel expenses are deducted without clear documentation of the meetings that's supposed to happen, or maybe marketing expenses included things that were only loosely related to the business. Each one by itself might not look like a huge issue, but when you add them up across multiple years, the exposure becomes real. If the IRS had reviewed those returns before the client came to us, the cost would not have been small. It would have meant additional taxes owed, interest on top of that, and sometimes penalties. And this is exactly what the write-off everything mindset produces over time. Not one big dramatic mistake, just small, optimistic decisions stacked on top of each other year after year until they're not small anymore. And here's something most business owners do not know. The IRS actually has a very clear standard for what qualifies as a deductible business expense. It comes down to 2 words, ordinary and necessary. Every deduction has to meet both of these tests at the same time. And a lot of people have heard those words before, but still do not fully understand what they mean. Ordinary does not mean common in everyday life. It means common and accepted within your specific industry and your business. For example, consultant deducting professional development courses would be considered ordinary, but that same consultant tried to deduct a safari because it expanded their worldview and make them a better advisor. That argument has been made before, and it had also been rejected. Now let's talk about the second test. Necessary does not mean essential or absolutely required. The IRS standard is actually a little more flexible. Necessary simply means the expense was helpful and appropriate for your business, but you still have to show that it serves a genuine business purpose. For example, a software subscription your team actually uses in the business would be considered necessary, but that same subscription for a tool no one ever opened would not be considered necessary, even though the business technically paid for it. And here's the part that catches people off guard. An expense has to be both ordinary and necessary. Passing one test is not enough. So here's a simple exercise I want you to try this week. Pull up your 3 larger deductions at categories from last year and ask yourself 2 questions about each one. First, would other legitimate businesses in my industry recognize this as a normal business cost? And second, what was the primary purpose of this expense? If you're being honest with yourself, was that purpose business or personal? If either answer makes you uncomfortable, that it's worth a real conversation before the next tax season. Now I want to walk through the specific categories that come up most often, because the IRS knows exactly where business owners tend to push the boundaries. And those are usually the areas they look at first. There are 4 expense categories that come up in almost every conversation I have with business owners once they reach a certain revenue level: the home office, vehicle, meals, and travel. And these are not random. They are the areas where there's often real opportunity for deductions, but they're also the categories where I see most consistent problems when they're handled incorrectly. In other words, these are places where good documentation and clear rules really matter. So I want to walk through each one with you. The home office is one of the most commonly claimed deductions and also one of the most commonly misclaimed. It's a legitimate deduction, but the IRS requires that the space be used regularly and exclusively for business, not the kitchen table where you eat breakfast, not the guest bedroom that happens to have a desk in the corner. It has to be a dedicated space that is only used for work. That exclusive use rule is where most home office deductions fall apart. And if you're deducting calculating a percentage of your mortgage, utilities, and insurance based on that space, the calculation needs to reflect reality, not whatever number maximize the deduction. The vehicle deduction works in a very similar way. Using a vehicle for business is a real and legitimate deduction, but the percentage you deduct has to match the percentage of actual business use. The IRS expects mileage logs, not estimates, not something reconstructed at the end of the year. They expect records kept as you go. If you drove 20,000 miles last year and 12,000 of those were legitimate business miles, then the deductions is 60%. If you deduct 90% because it feels about right and you use the vehicle a lot for work, and that is exactly that kind of things that get flagged. Meals are another category that the detail really matter. Business meals are generally deductible at 50%, but the requirements are specific. There has to be a clear business purpose. The people present need to be documented, and the business discussion needs to be the primary reason for the meal. Caught up with the client is not documentation. Met with John to discuss Q3 scope of work and renewal terms, that is documentation. The difference between those two things can easily be the difference between a deduction that holds and one that does not. And there's travel. Business travel is deductible when the primary purpose of the trip is business. But the IRS look at the number of business days compared to personal days. If you flew to a conference, attended 3-day sessions, and say 2 extra days to enjoy the city, the transportation is still fully deductible. And the lodging and the meals for the business days are deductible. The personal days are not. Where people run into real trouble is calling a trip 100% business when the actual business activity was one meeting or one afternoon of calls. So let me give you an example of how this plays out with a real client. We work with a business owner whose vehicle deduction looked unusually high compared to the size of the business. When we asked about it, he explained that he used a truck for work almost all the time. So every year he estimated the business use at around 90%. And the problem was there was no mileage log, no calendar that supported the number, just a rough estimate made at the end of the year. Once we actually reconstructed the mileage log using job locations, service calls, and the calendar, the real business use was close to 65%. That changed 2 important things. First, it brought the deduction back in line with what the facts actually supported. And second, it gave him a clear system going forward. He started keeping a mileage log and the numbers were supported every year. That is really the key idea behind all 4 of these categories. The IRS is not looking for perfection. They're looking for consistency between what you claim and what the facts actually support. Mileage log that matches your calendar, home office calculations that match the square footage, meal records that includes name and purposes, trip schedules that reflects real business activity. When those things lines up, deductions tend to hold. But when the story and the records tell 2 different versions of the same event, that is when exposure becomes liability. So here's a simple step you can take right now. Pick one of these 4 categories, whichever one makes you the least confident, and ask yourself one honest question. If the IRS asked me to support every deduction in this category from last year, could I do it? And if the honest answer is no, that is a conversation to have with your CPA before everything else. So now you know where the lines are. Here's a reframe I want to leave you with. The goal of all this is not to scare you away from deduction. It is to help you understand what a real tax strategy actually looks like. I want to be completely clear about something. Strategic tax planning is real. It's powerful, and it absolutely includes maximizing for deductions. But the business owners who actually build wealth through tax strategies are not the one writing off everything. They're the ones making intentional decisions about entity structure, retirement contributions, when income shows up and when it does not, and where profits are invested and how those investments are positioned. Those decisions create real tax deductions, documented, defensible, and built into the structure of the business itself. That is a fundamentally different thing than just calling expenses a write-off. I see this distinction very clearly with clients who come to us after years of working with someone who focused almost entirely on deductions. Their prior returns are usually full of aggressive write-offs, such as meals, travels, vehicles, every possible expense category pushed as far as it can go. But when we start asking bigger questions and something shows up, no one ever talked to them about their entity structure. No one walked them through retirement contribution strategies that could shelter large amounts of income. And no one discussed how to time the recognition of a major gain. And no one explained how an investment like real estate could interact with their business income in a meaningful way. Let me give you an example of how this plays out. A client came to us running a business doing just over $1 million in revenue. The business was profitable, the growth was real, But the entire tax approach up to that point had been very simple. Maximize deductions, file the return, repeat each year. When we review the situation more carefully, we realized something important. The business had grown significantly, but the tax structure had never evolved with it. No one had walked them through whether their current entity structure was still the most efficient. No one had shown them how retirement plans could be used to move significant income into tax-advantaged space. And no one had talked through long-term planning around investments and income timing. Once those conversations actually happened, the focus shifted completely. Instead of chasing deductions after the fact, you started planning the structure of the income itself. Which income would be taxed today? Which income would be deferred? Which income could be redirected into long-term investment structure? And those decisions create a very different result. Not just a smaller tax bill one year, but a structure that improved what the owner kept year after year. Those are the decisions that create real tax reduction, not the kind that disappears in an audit, the kind that is intentional, defensible, and that compounds over time. Because here's the truth about deductions. They're starting points. They're not the strategy. Deductions reduce what you owe on income you have already earned, but real tax strategy changes how much of that income is taxable in the first place, and ultimately how much of that you can keep over a long term. The business owners I work with who pay the least in taxes are not the one writing off everything. They're the ones who have a plan that starts in January, not April. They know what their projected income looks like, they know what their retirement contribution limits are, and they understand how their entity is structured and whether that structure still makes sense at their current revenue level. They're making decisions in real time, not reconstructing them at a year end and hope they hold up. One approach is strategy and the other one is hope. And hope is not something you want to rely on if the IRS ever decide to take a closer look. This is a question I want you to ask yourself honestly. When was the last time your CPA called you, not because you called them first, but because they saw something in your numbers they wanted to talk through? If you cannot remember that happening, that is your signal. You may not just need a tax preparer. You may need a strategic partner who actually thinking about your tax position all year long. If you have been writing things up and honestly are not sure whether those deductions would actually hold up, that's okay. Most business owners are not doing anything wrong on purpose. They just never had someone sitting down and clearly explaining to them how this actually works. The problem is not bad intentions. The problem is that no one ever showed them the difference between a deduction and a real tax strategy. And that difference adds up to more money than most people realize over time. If you want to see what that actually looks like, I have already made a full video talking through the top 10 tax strategies business owners should be using right now. It is the natural next step after everything we covered today. You can watch it right here.